Hello, good afternoon. Welcome to Mutual Fund Corner on CNBC-TV18. I'm Vinnii Motiwala, and thank you so much for tuning in as always. Now we are just near 31st of March. Financial year end is coming in. But overall, the mutual fund industry, have you seen that significant growth that we've seen in the last 10 years for the industry? Asset under management, that's AUM, that's grown around 5 times. And GDP has also witnessed an extraordinary growth in terms of the rise that we've seen. But how should one be considering this volatility that we're seeing in the market? What does it mean for your investments? How should you strategize it? What is the approach that you should make? Wealth creation, right? All of us want that. How is that going to be playing out for you all FY26 and onwards for this industry? What are we expecting? To discuss all of this, we have a very special guest joining in with us this afternoon. We have Vishal Kapoor, CEO at Bandhan AMC, joining in with us to talk to us about that. And Vishal, you have a vast experience in terms of the financial markets, in terms of how you've seen the growth coming in over the years. And I want to just start by talking about the basics in terms of the industry. Like I was saying right now, the last decade for India has been fabulous. We've become a powerhouse coming in from this industry as well. So your thoughts coming in on the industry, mutual fund industry versus the globe, and what are you seeing in terms of the outlook going forward for our industry?
So firstly, thanks for having me. It's a great pleasure. And diving straight into the question that you posed. See, I think India is benefiting and the fund industry is benefiting from 2-3 very large structural shifts that we are witnessing. The first is that, India was always an economy of savers. We had very high savings rate, credit came late into our sort of, into our ethos. And with a high savings rate, we were largely dominated by real assets like gold and real estate, and then financial assets were very, very conservative. So therefore, the role of capital markets, mutual funds within the overall savings pie was very, very small. Now that shift has been going on for almost like the last two decades, and that always builds up. So if that keeps going, which is people are saving a fair bit, even if it's coming down, but a larger proportion is coming into financial assets, within which a larger proportion is coming into mutual funds, then the growth, opportunity for us, the headroom is still several times where we are. Just to share with you, for example, mutual fund assets as a proportion of the GDP, AUM to GDP ratio, has moved up from roughly about 9 or 10% to now 18%, right? But another way to look at it is just 18%. Developed economies like the US are 130-odd%. Global average is closer to 75%. So even if you come to global average, you're looking at 18% of GDP going to 70-odd% of GDP, of a GDP which itself is growing so rapidly. So then you do the math and say, there is just so much more headroom that is available. So the asset AUM numbers, some of us think these are remarkable numbers. But another way to look at it is that the journey has just started, so there's miles to go.
It's just the beginning of the journey. So when would you think that maybe our industry is possible to reach that? Is it going to be sooner than expected, given that how we are growing as a country as well, right?
Yeah. So, we would certainly hope so. But I think it's also important to not get ahead of ourselves. And I think there are some good things that have happened which have led to this growth. First is investors' trust. This is a savings product. It is people's hard-earned money. And we have to be able to deliver to the promise. And therefore, how we communicate the promise, how do we deliver to the promise, and therefore, were people actually able to make the wealth that they were targeting? Were they able to meet their financial security needs, affluence needs, etc., through our product? I think that the broader answer would be yes over the last 2 decades, and we hope that that can continue over the next 2 decades as well. So that will, I think, precipitate that growth that we're looking for.
Vishal, what I also want to understand is that now, while we're talking so much about growth, the opportunity that is there, as an investor, if I'm investing in the mutual fund industry, what is the best way now to start right now and approach this strategy as a wealth creation opportunity for an investor, right? There must be a lot of new investors coming in as well. It's the beginning of this new financial year. So what is it that as a wealth creation journey that one should start with?
Right. So I would look at it as, let's say, 2 parts to what you would want to do. The first thing is that I'm a saver and I'm used to a certain set of financial products, maybe at bank deposit, etc. Now, when you come into the world of mutual funds, there's a lot of new terminology, the way it works, NAVs and in fractional units, there's an account statement, there's no certificate, it's all online, there's a distributor. So there's a lot of terminology, the nuts and bolts of the product that it takes some time sometimes to get used to. It's like, the first time you buy a share, you have to get used to a demat account and a custodian and this and that. So, you have to get used to that. I would say just put, even it's 100 rupees, 200 rupees, whatever, get started, put it. And, it doesn't matter where you put it. It can be a fixed income fund for all that matters, right? Because you're just getting used to how the product works, in a sense, right? Then you look at, okay, I understand how the product works. Where should I invest? That's where you get into what we would advise is allocation. Now, those things come later on if you're just getting started. The safe and simple thing to be done is that if you can save X rupees, take a proportion of that, ideally a high proportion of that, and put it into an SIP. Now, which SIP? You can start with a moderate risk product, like a hybrid product. If you're okay with some risk, you get into an equity product SIP. So there's a range that we offer.
A wide range. That is also overwhelming sometimes to see so many options now that are there.
That's right. Choose any one or two or three, and the average tends to be that people start with 2 or 3 SIPs, two or three different companies, so that your basket is a bit more diverse. These would still work very well. It used to work 20 years back. It still works very well. So why disturb a classic?
Absolutely. Right now, the current scenario, when anyone looks at it, right, last couple of months, or let's say the new year that we've seen in Jan to March right now, volatility has been something that is persistent in the market, right? As a new investor, what is it that you watch out for, right? You have seen so many cycles, and sometimes people start fearing. The recent AMFI data showed that the stoppage ratio, that's seen a sharp spike up as well, though overall the SIP number did remain around the 26,000 crore mark. But that worry comes in for a new investor that now what should I do? So how should a new investor look at all this, and what should their strategy be through such volatile periods as well in this industry?
Right. So firstly, I think we must all recognize that if we are investing, volatility is part and parcel of that investing game. Now, if it is one-sided, if it's a straight line, it's not an investment. So if you want growth,
we all cross our fingers for that one-sided move always.
Right, that's right. But that's not real. It's not going to happen. And if, as they say, if it's too good to be true, it's probably not true. It's going to come down, and therefore beware if it is a one-sided move, right? So volatility is natural, normal. It's almost a relief to have sanity come back to some extent in the market, saying, okay, this is not a one-sided market. There are buyers and sellers. There are differences of opinion, views, which is what causes some bit of this market to get discovered. So it's healthy to have volatility. It's nothing abnormal, right? Now, when you look at your own assets, your own wealth, and it's very natural to get worried that, I put in 1 lakh and only worth 90,000 rupees. I've lost 10,000 rupees. One, if you're anticipating it, I think start with how much risk can you absorb. And I see a lot of my distribution friends, partners tell people up front that, if you're putting 1 lakh, can you absorb 50% loss, 40% loss, 30% loss? What is your risk appetite? I think if the moment you know that I can risk up to so much rupees, as long as it is less than that, you're more comforted. Personally, what I follow is that don't look at your statement so often. Why do you need to look at it so often? Unless you need your money. Sometimes ignorance is bliss. And in investing, I would certainly say that, if you put your money away, the market is doing well. You can look at it periodically to say, is it largely in the right place or not? But looking at it every day is just going to help your doctor, not your portfolio.
That's true. It would surely help your doctor looking at that stress that you have suddenly that your portfolio is down. It's a lot of anxiety that creates. But, talking about the point in terms of a market that we're looking at, the uncertainty that is there, we are seeing about a smaller end of the market, the broader end of the market, that has been more uncertain, and that's where sometimes the worry comes in. Are there any, checklist sort of a thing that a viewer can maybe ignore or avoid to avoid the big mistakes when they're entering right now in such a market? Or do you think that there is value across board, given that we're seeing some bit of a correction?
Right. So I think the first thing I would advise is that seek independent advice. If you try and do it on your own, you have to be in it 24 hours. It's a profession, right? So like with any other profession, how many of us try and do it ourselves? And, sometimes we want to save a few basis points of fees here or there, etc. And really in the long term, you have to ask yourself, is it worth it or was it worth it? right? Because the quality and ability for someone independently to look at your portfolio and give you unbiased advice can yield a significant difference over the long period of time, much more than what the fear of paying someone something is, if that is holding you back a bit, right? Second is that, diversification is one of those freebies that the industry offers you. It doesn't cost you anything, right? And, sometimes in a phase that we've seen over the last 3-4 years, we can almost ignore the reason for diversification and many of these concepts to be still around, because you think, no, I'm smarter than the market. And then a Jan Feb comes in and, knocks you on the head once again saying, hello, volatility is real. So please look at the downside risk that you have in your portfolio. Don't get carried away. Yeah. And maybe sometimes in a market that can happen, we get carried away, we get, we take more risk than our appetite. Some amount of correction actually gets us back to ground.
Absolutely. And, Vishal, there's a point that you highlighted also, asset allocation, right? What is the importance, and in journey, how has that been for you as well overall? The key to go through maybe this industry is also diversifying your portfolio, but with that right asset allocation is also something that we should do. Help our viewers through this asset allocation journey.
Right. So firstly, when we look at selecting a product, often, and maybe all of us are guilty of that, we spend just an inordinate amount of time just looking at which product and which fund house and which scheme and which manager and fees and past returns, etc. And there have been scientific studies done 4 or 5 decades back, which are still true, which will tell you that actually all of that does not matter much to your eventual portfolio outcome. The single biggest factor that will determine the outcome of your portfolio, did you make wealth or not, more than 90% of the outcome is based on the simple allocation that you actually decided on. So everything around, did you get the timing right? Did you get the fund manager right? Did you get the pricing right? Did you get the the sector or the strategy right? Doesn't matter, actually, in the long term. 90% plus of your portfolio depend on how much of what did you get. So as an example, I got a multi-bagger in my portfolio. I doubled my money in this stock, let's say as an example, right? But it's 1% of my portfolio. Yeah. Okay, so 1 became 2. The remaining 99 was still 99. So how much money did I make? Doesn't matter.
Yeah.
It's just to illustrate that had you got this multi-bagger or this strategy right, with 60, 70, 80% of your portfolio, that's when you really get it right. So it's not really the stock or the strategy that you got right that mattered, it's the amount that you put in. So spend a lot of time thinking about the allocation, which is where a bit of risk balancing, a bit of, getting to see where growth is coming, what do you want to do about it, etc., comes in. All the other things are important, but not as important, and therefore, therefore your time spent can be in proportion, and get some professional help to help you do that, because there are good studies, models, etc., available, which will tell you what happens when you combine different assets. The sum of the parts is actually smaller than the whole that you create because of the benefit of correlation you get between assets. So that's for a longer conversation.
Absolutely, a longer conversation that we'll have. But right now, we're going to slip into a very short break, viewers. We'll be back with this discussion in a short minute from now. Welcome back to Mutual Fund Corner on CNBC-TV18. We still have with us Vishal Kapoor, CEO at Bandhan AMC, to discuss the mutual fund industry, the outlook going forward, what you all should be doing as well. Vishal, we were talking about asset allocation, right? And the importance of someone looking at asset allocation, how you highlighted certain points. What, according to you, is the best proportion, right, between, in the current scenario, equity, debt, or fixed income, other fixed income opportunities, commodities? What is the best allocation strategy that one could have right now?
So this is almost like a nutrition plan. So what's the best nutrition plan?
You're the best doctor, no? So I have to ask you for the best nutrition plan then.
No, that will really depend on the individual. And I think, generalization over there can be, a bit tricky. But by and large, I think if you were to use certain rules of thumbs, which are used, now it's a rule of thumb, therefore it's not going to be accurate. It's generally believed that when you're younger, you should take a bit more risk, provided your income is reasonably stable, and therefore the riskier assets or growth assets, which are things which are overweight equity, can be a larger proportion. So a lot of people will advise that, you know, when you're younger, you may have 70, 80% of your assets in equity-oriented products. The remaining is the shock absorber, the buffer you have in fixed income and cash. But as you get older and your earning years become lesser, you will need to depend a lot more on the savings and the wealth pool that you've created. You keep reducing your equity proportion and bring it maybe closer to a bit more balance in accordance with your age and risk appetite. So by and large, that is what will happen. Now, we are talking about a retirement corpus, by and large, you know, which is the most popular, the largest part of your savings. However, if there are, you know, smaller needs, you want to buy an asset 5 years down the line, then, you know, it'll have to be a very different journey using the same rule of thumb that you can afford more growth with volatility when you're far away from that target. And as you get closer, you reduce your volatility by going into fixed income and more stable assets as you get closer.
Absolutely. Thank you so much for that update coming in over there in terms of just a basic rule that one follows, not any specific percentage. Everyone has to go according to their financial goals as well, I believe, and how much time they want to achieve such things. But, you know, Vishal, let's talk about the options that we have, right? Lump sum, SIP as well.
Right.
What sort of a market is better for a lump sum one? If you have enough investments, is it always better the money is there, then is it always better to go for lump sum than an SIP?
Right. Interesting one. And I think, as in to me, you know, if you find real good value in the market and you're convinced that this is going to be, you know, it's very cheap, it's going to go unidirectionally up from here, then I would say why spread out through an SIP? Because if your expectation is the market is going to keep going higher and higher, then you're averaging up through an SIP, in which case a lump sum makes sense. But of course, it has to be dependent on whether you have the money. And therefore, the first question has to be, what's your cash flow situation? So if you're sitting on cash and the market is really cheap and your expectation is that it'll go unidirectionally up, this is the bottom I'm trying to catch, etc., then yeah, lump sum may make a lot of sense because you're trying to catch the bottom, keep in mind. Very difficult to do, almost impossible to do consistently. But if that's the call you're taking and that's the risk you want to take, then that still works. For most of us, we are not able to predict the market. We are not able to see, you know, how volatile it will be, whether it's going up or down or sideways. We really don't know. And that's where the beauty of something called rupee cost averaging, which is a mathematical concept, comes in, which is that when things are expensive, you buy less of it. When things are cheaper, you buy more of it. And that works beautifully for an SIP or an STP for that matter. And that therefore works most for you know, people who are unsure, which is the majority of us. It also, I think, ties in very beautifully with people who have a monthly income. So if you're going to save monthly, why don't you keep investing it monthly as well? Don't let that money lie idle and benefit from rupee cost average as well as the sort of process alpha you get through an SIP as well.
Vishal, what's the best way to go forward in FY26 now in this industry? What should the investor be looking at? What are there are so many options right now. We have the 250 rupees SIP option that comes in. There are so many NFOs that come in. What is the best way, right? When you have so much, how do you pick the right option?
So first thing I would say is, look, you know, don't panic with volatility. You know, accept it as very, very natural. It's like seasons. You know, this will come and go. So you know, this is something you just have to accept. If you're not panicking in your investment journey, I think the first battle is already won, right? Second is, if you're not panicking, you're not going to make any knee-jerk reactions to your portfolio, buy something just because it looks very attractive. Maybe it's very well marketed. Or buy or sell something because suddenly the mood has changed against it. You know, don't do that, right? Which is where I think if you have each of your savings goals or, you know, set up properly, it just helps anchor your thought of why am I doing what I'm proposing to do now, right? So I would say, therefore, if you have a goal for different objectives that you have, it just helps you anchor, gets your thinking become much clearer. Talk to your advisor, talk to whoever you think can act like a sounding board for you, right? And definitely don't disrupt your SIPs, STPs just because the market is going here and, you know, what is the world telling you about what is going to happen, etc., because those are times when the best opportunities also emerge. Just a few weeks back, everyone was thinking and talking about apocalypse. You know, this has already come down so much, it's going nowhere, etc. Look what the market has done in March. So it's just a reminder that, look, please don't try and predict every day, every month movements. If you're investing for a long-term goal, and that is still very, very visible, then why make any sudden changes? Your cash flows, your earnings have to be matched in proportion to that goal. You just need to do a bit of refinement once in a while, maybe 6 months, maybe every 12 months or so, but that's about it.
6 months or 12 months, one should at least review their portfolio, right, and go through it. Do not panic. Please do not panic and get out of, your investment strategy. That is important as well to continue to maintain it. Vishal, the trend that we saw in the last year or so was thematic funds, sector funds. We had so much that was happening because our market was also at such a phase where you used to see these specific sectors, specific themes doing well. As a strategy option for an investor, maybe who's starting out, how should they be looking at thematic options, and how do you see thematic funds, sector-specific funds go from here on in 2026, 2025, 2026?
And it's a great question because I think, clearly thematic funds are not meant for new investors, right? So if you're a new investor, I think sticking to the more well-discovered ideas, the broad-based funds, the hybrid funds, etc., is a better starting point, right? Thematic funds are, I think, meant for more evolved investors who are looking for sharper growth, sort of opportunities, right? So you've got your the vanilla strawberry options there. It doesn't mean that the sprinkles are not good or the other combinations are not good. They're good, but that's not your mainstay. And they will mean, in the case of investing, that you are taking more risk because you're pursuing a higher growth strategy with an idea or one construct or one strategy, etc. There is no free lunch. So if you are looking for more growth, it will be more volatile. It may be more cyclical. It may be structurally something that you are, not so sure of, etc. Now, because our industry now has a fairly sizable, seasoned investor base, I think for them the question had become that what next, what more? I want to take more risk. In which case, of course, the industry will innovate and try and look at, themes that may be more sharper to serve your needs. By and large, these are seen as what are called satellite products, satellite to the core. The core still has to be a mainstay, product which is more diversified, more stable, and therefore adding a bit of growth spurt, adding a bit of masala, the spices on top, is what the thematics should be around.
Absolutely. That's a great one there, Vishal. Thank you so much for joining in with us on the show. It's a pleasure having you, understanding the journey for an investor in terms of what they should be doing. So thank you so much for that. And thank you so much, viewers, for tuning in to CNBC TV 18. With that, we'll wind down this edition of Mutual Fund Corner.